So day number 1, we will be covering these 3 different areas of the syllabus, which includes the basics of Indian financial system, and that too an overview, not in detail. Number 2, the banking regulation. Okay, I'm sure that banking regulation part will be in detail covered in legal and regulatory aspects of banking, paper number 3. And if some of you are not even appearing for that and you are only attempting for PPB, then this area is already in detail covered in that particular paper. Number 3 is the retail banking, wholesale banking, ADR, GDR, and participatory notes. This is the part today we are planning to cover. And in case we won't be in a position to cover, don't worry, spillover part we can manage on day number 2 or day number 3. And day number 2 is this part that I will not spend time on that, but you can have a snapshot of it. Day number 3, we are planning to cover these larger part of the syllabus: factoring, forfeiting, risk management, Basel I, Basel II, then credit information companies, recent developments which have happened like this. Okay, all these aspects will be covering on last day. So these 3 days, every day 1.5 hours I'll be talking to you, and in this 1.5 hour process, I'm sure you will get totally connected with the banking and banking only. And since you are already a banker, most of the things are known to you. Most of the things means almost 90% things are known to you. Then if that is the case, why I am talking to you? Please make a note. Though we feel that as a banker, we know 90% of banking, I think after completing this module A, you will come to know that what you know is hardly 10% and what we don't know is 90%. What we don't know is 90%, and has to be a perfect banker, because it is making you prepared not for only JIB examination, but actually it is making you ready to take a leadership in banking in days to come. And that is what is the entire objective of this particular paper. Okay, hope I'm making the points clear. Are you getting me, please? Is it okay?
Yes, sir.
Hello?
Yes, sir.
Yes, sir.
Yeah, fine. See, under the financial system, what is that? RBI, commercial banks, payment bank, small finance bank, LAB stand for local area banks, NBFCs, primary dealers, financial institutions, payment and settlement, CRR, SLR are the part, and followed by the equity and debt market, that is stock exchange, broker, investment banker, FIIs, depositories, mutual fund, and then IRDA. Okay, then multi-commodity exchange and forward contract regulations. This is okay. Now, then part 2 means whatever we are planning to cover today, part 2 is a banking regulation, then functions of RBI, instruments which are used by RBI, which is already covered, direct instruments and indirect instrument. Then what is that market stabilization scheme and the issue of currency, all those duties, then developmental role of RBI, then regulatory restrictions, etc., etc. This is what is the coverage for the entire topic of the day. Now, what do you think? Is it already known to you, or many of the things are not known to you? Yeah, you can reply me in the chat box. Is it that you feel that you would be knowing many things, or you already know many things? Can I get a reply in the chat box? Do you think that you would be added knowledge today, or you already know everything and it is just repetition of what you already know? Yes or no? Good. Thank you. Yes, it seems to be know many things, but let us see what we know and what we really wanted to know. So next, thank you so much for wonderful responses. Indian financial system. Indian financial system means what? See, it is a system which is developed with the help of institutions, market, and the instruments and the support things, wherein people in the economy who have got surplus capital that is coming to get channelized and allocate to these areas where it is really needed. In a simple words, transformation of savings into investment and consumption is what the job of Indian financial system. And whatever we are talking about only the formal financial system and not the informal financial system. Okay. And under this financial system, what are all the things involved? As you know pretty well, the Government of India, Ministry of Finance is the top of it, under which the regulatory authorities are there to carry on or to manage or to regulate or to control various financial institutions and financial market intermediaries or facilitators such as RBI, SEBI, IRDA, PFRDA, NABARD. Then financial intermediaries like banks, institutions, NBFCs, financial markets, money market, capital market, forex market, and the financial instruments such as treasury bill, dated securities, bonds, certificate of deposit, commercial paper, shares, debentures, and then last but not least, supported by financial services. These are the 4 key pillars of Indian financial system. Which are all the 4 pillars of Indian financial system? Financial intermediary, financial market, financial instruments, and financial support services. Hope this slide is clear. Can I move further? No doubt on all these aspects in detail, I'll be talking to you. So let us see now. When we talk about the financial institution, there are number of institutions involved. So which were the institutions? Can you tell me? See, which were the institutions? Bank, NBFCs, mutual funds, cooperative society, insurance companies, and pension funds. Now, banks. How many type of banks are there in India? How many type of banks are there in India? Can you tell me, please? How many type of banks are there in India? Okay, basically, banks are classified into how many categories?
Private sector.
Okay, very good.
Cooperative banks, commercial
Cooperative
bank,
scheduled commercial bank.
Very good, very good.
cooperative
SCB.
bank, cooperative bank,
Very good, very good.
Foreign banks,
And
foreign banks,
private bank.
differentiated banks.
Regional banks.
Okay. Scheduled commercial banks, cooperative banks, and differentiated banks. Okay. Now, out of this, what is the scheduled commercial banks are classified further? These scheduled commercial banks are further classified as the public sector banks and the private sector banks and the RRBs. Are you getting me, please? Public sector banks and the private sector banks and the regional rural banks and the local area banks. Now, what is that classification means? See, public sector banks and private sector banks are, you can appreciate, but how come these 2 extra classifications? That is RRBs and local area banks. In addition to this, there are cooperative banks. In addition to this, there are differentiated banks. So now I think you might have got a clarity. One is either scheduled bank or non-scheduled bank. And the scheduled or non-scheduled has a bearing with regard to Reserve Bank of India's categorization of a particular bank into a scheduled category or a non-scheduled category. The scheduled one is a bank which is incorporated or listed or there is annexed to the schedule number 2 of Reserve Bank of India Act 1934. And then when you talk about the public sector bank, how many are the public sector banks in our country? How many public sector banks are there in our country? Okay. How many private banks are there in our country? Out of private, how many domestic private and how many foreign? Then
domestic
how many
private is
regional
13.
rural banks? Okay. As of 31st March 2021. Okay. How many local area banks are there in our country? How many small finance banks are there in our country? And how many payment banks are there in the country? Now, can you really find out these details from your own sources tomorrow and come back in my class? Are you getting my homework?
Kulkarni sir, in that module, legal module, everything will be discussed in detail. All this public sector.
Yeah, you will be discussing with detail. Therefore, I will not invest my time on that then.
Yes,
okay?
sir. Yes, sir. It will be discussed in detail.
I will not discuss. I'm just asking them to go with the homework so that they'll be ready even for interaction in that class. Okay. Please complete this homework. Okay. Then let me now carry on with this market part. Okay. Because financial market part, I'll be talking to you in detail today. Okay. As far as financial market concerned, there is a money market, there is a debt market, there is a forex market, and the capital market. And as far as other financial intermediaries concerned, other than the bank, that is insurance, IRDA, as well, and the mutual fund and the SEBI. Okay, SEBI as a regulator, mutual fund as the company, and as well as insurance companies and the IRDA. That aspect will be definitely covered in detail in our class. Okay, and the money market. When we talk about the money market, so it covers this call and notice money, treasury bill, term money, certificate of deposit, and I'm talking to you. I'll be talking to you in detail about all these aspects in just short while. Okay, please wait for that. These are all the aspects I'll be talking to you. Okay, as far as when it comes to the debt market, there is a government security as well as the corporate bonds. Means this government security, when we say, either that is the security issued by central government or the state government. Okay, and the bonds are issued by mostly financial institutions or public sector undertakings or other corporates. Okay, and thereafter the forex market is there. In that we'll be talking in our class a few aspects relating to LIBOR. Imports and exports you will be having in detail again in the module A of accounts and finance and accounts for bankers. Okay, AFB, accounts and finance for the bankers. But still, if you in this particular class, we'll be just having a overview. What are all these services under the international banking the banker would be providing to people? Okay, and then the capital market part comes. We'll be talking about the SEBI as well as shares, debentures, and bonds. Okay, and this is what is mostly a part covered in module A. In addition to this, there are other aspects which I have already shared with you. Shall we go ahead? Then let us this also. Okay, as far as RBI concerned, all of you are aware that RBI is a central banking authority of our country, and as a central banking authority of our country, it actually controls inflation and it ensures the economic growth. This dual role of economy is carried out by Reserve Bank of India through monetary control, and this monetary control is ensured by Reserve Bank of India through Monetary Policy Committee. This Monetary Policy Committee is actually constituted by Government of India, wherein Reserve Bank of India governor would be the head of the committee, and there are two other members. Those are executive director, that is the Reserve Bank of India's deputy governors are the two members. Okay, executive directors of Reserve Bank of India, that is okay, deputy governors, and then the benchmark and policy rates decision is by the Monetary Policy Committee. Monetary Policy Committee takes care of only deciding the policy rates. And now when I'm talking about the policy rate, you may be having a doubt what that policy rate means. Policy rates means the rate of repo and rate of this reverse repo and rate of MSF and the bank rate. These are the four rates, and out of which most important are the repo, reverse repo, and this MSF. Those are being determined or decided by the Monetary Policy Committee. And Monetary Policy Committee's head is Reserve Bank of India and the two deputy governors of Reserve Bank of India. Okay, and three other members are of the nominated by Government of India. Likewise, 6-member committee, and that's way the decisions are being taken by Monetary Policy Committee with regard to review of the policy rates on bi-monthly review of monetary policy or credit policy, which is named as credit policy of the country. Okay, is it clear, friends? Is it clear? Now, as far as the second job concerned, the Reserve Bank of India is actually regulating the banks and supervising the banks. Under the regulation, it gives the license. It provides certain norms which every bank need to follow with regard to capital adequacy and the risk management. Then the income recognition and asset classification and provisioning norms. It controls through, it ensures that whatever regulatory prescriptions are given by Reserve Bank of India are followed by banks under the regular inspection. And the last but not least, the guidelines for corporate governance. And Reserve Bank of India not only regulator for banks, it is also regulator for NBFCs and the primary dealers as well as financial institutions. And last but not least, even it is a regulator for clearing and payment and settlement system of our country. And as you know pretty well, it is the lender of the last resort. Means what? Means in case the need of a finance comes to the bank, then banks can rely on Reserve Bank of India for the purpose of funding. Now, when Reserve Bank of India funds, it funds in a different way, and how it funds, how that is being managed with the repo and reverse repo, we will understand a short while. Please wait for that. Okay. Then it acts as a banker to the government. Means what? To cater the requirement of funding. Either it is a short-term funding or a long-term funding. The debt raising for the government by issuing various instruments such as treasury bills and dated securities, the Reserve Bank of India would be controlling that entire account. And that's how it acts as a banker to the government. Then it also manages the debts of the government. Then, as you know pretty well, the currency management of the country, that is issue of currency, issue of banknotes. Okay, the currency notes, issue notes are printed and managed by Reserve Bank of India. But I think all of you are aware that 1 rupee note is not at all being issued by RBI since it is a currency. And whereas other than 1 rupee note, the remaining notes are issued by the Reserve Bank of India. And notes ranging from rupees 2, 5, 10, 20, 50, 100, 200, then 500 and 2000. All these notes are being signed. You can see on the note, the promise is given by Reserve Bank of India that when you surrender this note to RBI, they will be giving you the so many rupees. That is what is a bank note. And those are being managed by Reserve Bank of India. Okay. And in detail, you will be having that also in the other session. And I'm sure that you need not have to have the detailed discussion with regard to that part. Okay. Then, however, if you have any doubt, please ask. No issue. Okay. Then next is the payment and settlement system regulating. How it is done, we will discuss in a short while. Either today or tomorrow, this topic will come. As far as managing foreign exchange concern, it is actually controlling the foreign exchange, regulating or supervising the foreign exchange market. Actually, straight away, there are no rules for that by Reserve Bank of India to buy and sell. But Reserve Bank of India tries to manage the market so that rupee value should not come down and rupee value should not go up. It should have the parity of exchange. And that is what is the market management RBI does by pumping the foreign exchange or otherwise sucking the foreign exchange from the market. By pumping the foreign exchange, it makes the foreign exchange available for people, and so that rate will be getting stabilized and rate will not go up very high. Whereas by sucking the foreign exchange, it manages the value of rupee against the foreign currency. Okay. And as usual, the money market regulation through various money market instruments are being done. And last is a very, very important role, a developmental role. And in Indian financial system paper, as far as detailed discussion, we will have on entire money market in detail. Okay. Even payment and settlement of system, you will have the discussion in module C as well as in module A. Okay. And other areas being a simple one, that is a banker to the government and all, we will not invest much time, but detailed discussion we'll have on treasury bills, okay, the government bonds, other aspects, okay. And please make a note of these policy rates and policy reserves. Cash reserve ratio as of today, statutory liquidity ratio as of today, repo, reverse repo as on today, and MSF and bank rate as on today. Please make a note of it, and to have the updated knowledge on this, you are always welcome to visit the rbi.org.in, wherein you will find on the left side the policy rates and policy reserves tag. And with that, you can always have the check on these things and get yourself updated. Okay. Can I move further, friends? Some chat is there. Yeah. List rename. Select rename. Yeah. Actually, public sector banks, I think someone has replied. You may please correct yourself. There is something more. Okay. So, as I already told you, the MPC aspect, this is only a repetition of same slide. Whatever I have discussed. What is the monetary policy's job? Monetary policy's job is to regulate availability, cost, and use of money, use of various instruments which are there under the control of RBI in an effective way, and in order to ensure low and stable inflation. Okay, it is not the reducing, okay, stable inflation trend, and promoting economic growth, ensures adequate flow of credit to productive sector is the objective, and this objective is achieved. For that, target for controlling inflation, okay, controlling inflation as per the below targeted level is the job of this monetary policy committee, and it does through managing the policy rates, and hope you are getting the points with abundant clarity. Are you getting me? Now let us see now which are all the direct instruments available for Reserve Bank of India to manage the monetary policy objectives. Direct instruments are CRR, SLR. Direct instruments are CRR, SLR. Indirect instruments are liquidity adjustment facility, open market operations, marginal standing facility, and market stabilization scheme. Okay. Now, as far as the CRR, SLR concerned, some of you may be well aware about that. Okay. Now, still my question to some of you, what is CRR? Cash reserve ratio. What is SLR? Statutory liquidity ratio. Now, what is the difference between these two? What is the difference between CRR and SLR? What is the difference between CRR and SLR? Can anyone reply? Hello? Cash and non-cash. Still, I want a clarity, my friend. Ganesha, I agree, but I still want a clarity. Okay, funds maintained with RBI are CRR. And what is SLR then? CRR have to maintain all day. Yeah, means SLR also need to be maintained. CRR also need to be maintained. Okay, so let us see now. Okay, number one, cash reserve ratio is regulated under this, as per under section 42(1) of RBI Act. Okay, 42(1) of RBI Act 1934. Whereas SLR is as per section 24 of Banking Regulation Act. Is it clear now? Number one point is clear. Number one difference. Number two difference. This CRR need to be maintained by all scheduled commercial banks, and that to be, it is to be maintained with RBI. Means banks are supposed to part with the funds. Banks are supposed to part with the funds, and those funds are necessarily required to be part with RBI, necessarily required to be kept with RBI, and as a definite percentage of net demand and time liabilities. Okay, and on these funds there is no interest earned by or the banks. No interest is paid by Reserve Bank of India. Whereas SLR is simply investments made by the bank in the stipulated securities or specified securities which are specified as per the Trustees Act. Okay, those specified securities where banks are required to park their money, that is SLR. And whatever money is parked, it earns some return, some income to the banks. That is the SLR. Third thing, non-scheduled banks are required to maintain CRR with respective banks themselves. Number 3, there is no floor, no ceiling. There is no floor, no ceiling. Whereas in SLR, there is no floor, but there is a ceiling of 40%. Okay, it can't go beyond that. Then next, it is required to be maintained fortnightly basis as stipulated. Okay, on fortnightly basis, by reporting Friday, it need to be reported. It need to be maintained on any day. At any day, it should not fall below the 90% of specified one, but on final day, it must be 100% of stipulation. Okay, and this 90% is changed during the this corona period, but based on this, the CRR is got to be maintained. Means we required to maintain 4% of NDTL, net demand and time liabilities. Now, for example, out of the 15 days, on any 2 or 3 days, it may come down the less than 4%, but no problem. On reporting Friday, it should be compulsorily 100% matching. But on any day it is going less than 90%, then it is considered as default. On reporting Friday, if it is less than the required one, then it is considered as default. And for default, there is a penalty. There is a penalty, and that penalty is 3% plus bank rate. Bank rate plus 3%. Bank rate, and if the default continued, then 5% plus bank rate is the penalty. Hope CRR is clear to you. Is it clear, friends? Can I move further? Can I move further? Hello? Is it okay? Yes, thank you, Balamurgan. Good. Thank you. And what is SLR? As I already told you, simultaneously, I have covered that. Okay. There is no lower limit, but there is an upper limit of 40%. Section 24 of Banking Regulation Act. All these things I have already told you while talking to you the difference. And that was the idea. Why did I ask you the question? Okay. So SLR is maintained in the form of cash with the bank, gold, excess CRR, investment in CSLR securities. Okay. And even here also, if we don't achieve the SLR, then there is a penalty. And penal interest is same 3 plus bank rate and 5 plus bank rate. Okay. So please make a note, 100% question will be there on CRR SLR. Okay. Then what is this marginal standing facility? MSF rate is also there. You might have seen there when I was talking to you about RBI, I have shown you a MSF rate. What is MSF? MSF stands for marginal standing facility. What is this marginal standing facility? So now let us try understanding the concept called as bank borrowing by the banks by investing certain securities with Reserve Bank of India. Now in the process, what happens? No, sometimes we may not have a securities in the hands of the bank. Means bank may not have a securities. It may be having only now 18% which is required to be stipulated, and no more securities are available with the bank. Okay, for example, out of 100 rupee deposit, we are supposed to maintain 18 rupees in the form of certain specified securities. And what we did, we have invested the 24 in securities, but what happened, due to some urgent requirement, we might have again lent this 6 rupees securities to RBI and might have borrowed. Now we don't have any more securities, but bank is in need of funding. What bank should do? In such cases, what RBI is permitted, you may further go down 2% of the demand and time liabilities. Means 2% even more, you can reduce it, and whatever that SLR securities are there, you may make use of it, and that's the way you can borrow from Reserve Bank of India. Since it is actually Reserve Bank of India is permitting to make use of your SLR securities, it charges little bit more. And that is the reason that 0.25% more than the repo rate is 0.5% or 0.25%, that more than the repo rate is there for the MSF or marginal standing facility. And normally this borrowing is permitted for 1 day, and only on Friday one can borrow for more than a day, because on Saturday this can't be exchanged or traded or sold back. That is what is the issue. Is it clear, friends? And this margin in the form of against the dated securities and treasury bills, bank required to have 5%, and state development loan bonds, those are being offered as security, then banks are required to maintain a margin of 10%. Okay, so this is what is the marginal standing facility. Yes, now I'm moving further. Can I? What is the bank rate? Bank rate and marginal standing facility rate more or less are same, because once upon a time, actually bank rate was very frequently used, because banks used to borrow from Reserve Bank of India, and Reserve Bank of India used to finance by rediscounting bill of exchange or commercial papers of bank. But nowadays, the other mode of borrowing money for the banks are available in the money market as well as the capital market. So the banks are not using this particular source of Reserve Bank of India. Secondly, bank rate is nowadays is strictly used as a reference rate for many aspects. Now, just now you have seen for CRR, SLR penalty purpose, bank rate is put to use. And the third thing is bank rate is as per the section 49 of RBI Act 1934. Means RBI Act 1934 has got bank rate and CRR and bank rate, whereas Banking Regulation Act has got the SLR. Okay, CRR is as per 42, bank rate is as per 49, SLR is as per 24. That's how you can make a note of it. And mostly bank rate and MSF rates are same mostly. Then whenever Reserve Bank of India feels that there is a lot of liquidity available in the market, then it tries to suck the money from the market by selling the securities and sucking the money. And whenever it feels that there is no liquidity available in the market and banks are struggling with that, then it tries to buy the securities and inject the liquidity. So this is what the job is done by Reserve Bank of India under open market operations. This idea is clear, and all these are indirect instruments. And the next very, very important is in order to maintain the stability in the money market, this scheme was introduced in 2004. Whenever Reserve Bank of India finds that there is a surplus liquidity or more enduring nature is arising out of large capital inflows, means when lot of money is pumped in the money market and Reserve Bank of India feels that need to be sucked, then what happens? The government don't want the securities to be issued. Then Reserve Bank of India makes this issue of government security and maintains in a separate account with RBI, because this is exclusively used only for stabilizing the market.
If you like our content, do like, share and subscribe.